Thank you. Risks to economic growth have become more balanced. While recent trade agreements have reduced uncertainty, a renewed worsening of trade relations could further dampen exports and drag down investment and consumption. A deterioration in financial market sentiment could lead to tighter financing conditions, greater risk aversions, and weaker growth. Geopolitical tensions, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, remain a major source of uncertainty. By contrast, higher than expected defense and infrastructure spending, together with productivity-enhancing reforms, would add to growth. An improvement in business confidence could stimulate private investment. Sentiment could also be lifted and activity spurred if geopolitical tensions diminished or if the remaining trade disputes were resolved faster than expected. The outlook for inflation remains more uncertain than usual as a result of the still volatile global trade policy environment. A stronger euro could bring inflation down further than expected. Moreover, inflation could turn out to be lower if higher tariffs lead to lower demand for euro area exports and induce countries with overcapacity to further increase their export to the euro area. Trade tensions could lead to greater volatility and risk aversion in financial markets, which would weigh on domestic demand and would thereby also lower inflation. By contrast, inflation could turn out to be higher if a fragmentation of global supply chains pushed up import prices and added to capacity constraints in the domestic economy. A boost in defense and infrastructure spending could also raise inflation over the medium term. Extreme weather events and the unfolding of climate crisis more broadly could drive up food prices by more than expected. So looking now at the financial and monetary conditions. Since our last meeting, short-term market rates have increased, while longer-term rates have remained broadly unchanged. However, our past interest rate cuts continued to lower corporate borrowing costs in July. The average interest rate on new loans to firms moved down to 3.5% in July from 3.6% in June. The cost of issuing market-based debt was unchanged at 3.5%. Loans to firms grew by 2.8%, slightly more strongly than in June, while the growth of corporate bond issuance rose to 4.1% from 3.4%. The average interest rate on new mortgages was again unchanged at 3.3% in July, while growth in mortgage lending picked up to 2.4% from 2.2%. So in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions. Thank you.
First question goes to Jana Rando of Bloomberg. Jana, please.
Right, let me organize myself here.
Hello, good afternoon, and thank you for taking my questions. Madame Lagarde, economists believe the ECB's easing cycle is over, and with the outlook broadly unchanged, as you mentioned, would you say they're right? And would you say everybody on the Governing Council agrees on that assessment? And my second question is about inflation. You mentioned a whole bunch of inflation risks, and I am wondering, would you say they are balanced? Thank you.
Well, thank you so much for your two questions. Let me say this. The disinflationary process is over. And I'm referring here to the causes for inflation that we have experienced in the last few quarters. So, in anticipation of a possible questions, are we still in a good place? Well, we continue to be in a good place, okay? Now, why do I say that? Because inflation is where we want it to be. Latest reading, 2.1.
This is Bloomberg Television. I'm Bonnie Quinn in New York. Today marks the 24th anniversary of the 9/11 attacks. Memorials are being held to honour the victims, first responders, and all of those around the world impacted by the attacks. We go now to a moment of silence in observance of when United Flight 175 struck the South Tower of the World Trade Center.
Following the events of this tragic event. May God bless our nation and the whole world. Ave Christus Rex.
Gary Eugene Bird.
Joshua David Birnbaum.
George John Bishop.
Chris Romeo Besson.
You've been listening to a moment of silence at the 9/11 memorial. You can continue to follow the ceremony on your Bloomberg terminal at Live Go. We return now, though, to the European Central Bank news conference in Frankfurt.
What I have just formulated for you is something that was agreed unanimously around the table. On your second question, which deals with the risk to inflation, we don't actually narrow down the risk to inflation exclusively. We assess the risk on the activity, on growth. And that's where we say in our statement that risks are more balanced. But we don't nail down a risk diagnosis on inflation in isolation. But I'll be happy to come back to why we are more balanced. Maybe somebody else will ask that question. Who knows?
Next question goes to Annette Weisbach of CNBC. Annette, please.
Annette Weisbach, CNBC. Thank you for taking my question. I'll just follow up on that question. So why do you think risks are more balanced now, given the uncertainty still which we see elsewhere in the world? And of course, I need to ask you about France. We've seen, of course, that the political situation and the unstableness of the country has driven bond yields quite high. So how concerned are you about a déjà vu which we had some years ago? Thank you. Not with France, but with other countries.
Gosh, I like it when you start speaking French. Déjà vu, huh?
School there, right?
Pretty good. So, more seriously, more balanced. I thought about it because I thought that one of you might have the question. You have to go back to where we were back in June, really, where we do the assessment of risk on the basis of the projections. And if you walk back to June, we had a highly uncertain situation. It was post-April 19, sure, but it was pre-July and certainly pre-August 21 when a deal was agreed and documented, however it was documented, but documented. And as a result of that, I think that two things have clearly moved out of our radar screen when it comes to downside risk. The first one is the risk of European retaliation. That was factored into our June projection, and that was considered as one of the risk in a trade war, as we had it at the time in terms of fear. The second thing is the uncertainty. So what we call, trade uncertainty, that has clearly diminished. And we can see that in the instruments that we use to measure uncertainty. It has not gone back yet to where it was pre-COVID. It's not the sort of normal level, and maybe there will not be a normal level. That's something that we really have to consider and take into account for future determination. It could well be that there was a reset in uncertainty around the world because of the trade situation, because of the geopolitical environment in which we operate. But the trade uncertainty has abated since June, when we had our last projection. So that's really what is at the root of this more balanced indication. It's not to say that risks have vanished. It's not to say that we are short of challenges. There are new risks, probably. There might be new ones. There will be new challenges, which really sort of anchors our determination to work meeting by meeting and to assess each and every time what the situation is. And, we are post new strategy. And you will remember that one of the innovation in our new strategy is that we not only look at the baseline, but we look and discuss the risks around the baseline on the basis of work that is sometimes published, sometimes not published necessarily, which is sensitivity analysis. I see some of them saying, what, it's not published? There are certain things that we keep to ourselves. Yes, we publish a lot, we share a lot, but sensitivity analysis, scenario analysis, and sometimes we do publish the scenarios, for instance, sometimes we don't, because we don't think it's absolutely relevant or helpful, but at least it informs our judgment. Oh, and you have the second question. Yeah. Look, I'm not going to comment on individual countries. I avoid that because we are the European Central Bank. We are not, narrowing our judgment on a particular country. But, I would say that I'm confident that the policymakers, that those who make decisions, will take it to heart in that period of uncertainty to reduce uncertainty as much as possible. There is also a set of rules that is the fiscal governance, the fiscal framework, that is the internal rules of the European countries, and the member states have to adhere to it, have to deliver against it, and I'm sure that all governments, wherever located, will want to operate on the basis of that fiscal framework. Thank you.
Francesco Canepa of Reuters, please. Francesco.
Thank you very much and good afternoon. So you said that inflation is projected to be a target over the medium term, yet the projection for 2027 is at 1.9, so below 2 for the second year in a row. So where does below target start? And the second question is, again, about France in terms of the specific rules of TPI. How far are we from a disorderly and unwarranted move on the bond market? Thank you.
Call a spade, huh? Okay.
Always.
So, yeah, you're right. So let's go to the inflation projections, if you will, because that's your first question. We have projections for 25, 26, 27. 25 and 26, we have increased by 0.1% our projection, right? So 26, our projection is now 2.1, and we've increased it by 0.1. In 26, we are now at 1.7. So in 27, we are at 1.9. And that's, first of all, it's a big 1.9. I hasten to add. But it's really on account of the exchange rate impact with the lag effect that it usually has, and this is factored into our projections. That explains to you the fat 1.9. I would also refer you, and I don't need to do that because you're very familiar, but we have indicated very clearly in our strategy that minimal deviation will not necessarily, if they remain minimal and not long-lasting, will not necessarily justify any particular movement. So, on the second question that you asked me, and this relates to France, I suppose. So I'm going to tell you the same thing. I'm not commenting on any particular country. But suffice to say that we always monitor market developments. And euro area sovereign bonds are orderly and are functioning smoothly with good liquidity. That's what we see, okay? But, you know, our focus is, as you know, price stability, but we need financial stability for that, and it requires a well-functioning monetary policy transmission mechanism. And we believe that we have all the necessary tools, if needed, should that transmission not prove efficient throughout the entire euro area. Thank you.
The next question goes to Aude Kersulec of the French TV channel BFM Business. Aude, please.
Thank you for taking my questions. Do you consider that quantitative tightening significantly contributes to the monetary policy stance? And to what extent does it reinforce tighter financial condition or not? And second question, do you consider that a widening of certain spreads over Germany will pose a serious threat to the transmission of monetary policy? And in such a case, could this trigger the use of the TPI even in case of major fiscal challenges for some countries?
Thank you for your two questions. So on the on your first question, in the situation where we are of this disinflationary process and having increased rates from minus 50 basis points to 400 basis points, the most efficient and primary tool that we use for monetary policy stance is the interest rates, as you will have seen. And we have cut interest rates by 200 basis points over the last 12 months or so. The fact that we are not reinvesting and that we are letting our portfolio on a runoff mode is proceeding smoothly. We had telegraphed it very carefully. It was anticipated, it was predictable, and I think that everyone who cares about those issues knows exactly how this proceeds and what very limited impact it has. That's a resolution that we have made, that we have explained very clearly to markets, and it proceeds accordingly. Now, as I said, we are always monitoring financial market developments. As I said as well, euro area sovereign bond markets are orderly and are functioning smoothly with good liquidity. If you observe the spreads, they have considerably tightened over the course of the last 2 years, and the spreads relative to bonds have a rather limited width between the other member states relative to the German bond. Thank you.
Next question goes to, from the Bulgarian news agency, BTA, Stas Stampolsky. Stas, please, here in the middle.
Hello, thank you for having me. You welcomed the Bulgarian governor, Dimitar Radev, as observer until 1st of January, when Bulgaria will become the next Eurozone member. How you see the benefits and the risks of Bulgaria to become part of the Eurozone regarding maybe inflation and deficit? and how you see the Bulgarian input in terms of the monetary policy decisions?
Well, thank you for your question, and you give me a chance to say something that I wanted to say in the first place, which is that on the occasion of this Governing Council meeting, we had a chance to welcome 2 new members around the table. The first one was the new governor of Austria, Martin Kocher. Forgive the pronunciation. I'm doing my best, but who has joined us to replace Mr. Holzmann. And the other person that we greeted at the table was indeed Dimitar Radev, the governor of the National Central Bank of Bulgaria. Now and I would like to welcome those of you from Bulgaria, because I know that there is a number of you who are present in the room, and I hope your colleagues will welcome you, but I certainly welcome you, and I know that you are spending a little bit of time with us, and it's very, very welcome, because it's wonderful to accept and to include a new member around the table of the Governing Council, and to have Bulgaria join the Euro area and share our currency, which is now yours as of January the 1st. So, having said that, you bring me back to a couple of decades, more than a couple of decades ago, when all of us moving into the euro from wherever we were, the Deutschmark, the franc, the lira, the pesos, we had this anxiety. You know, what was that change going to be about? Would it work? Would it function instantly? And surprise was to the upside, I can assure you. So it worked. It removed this nightmare of having to change from your local currency to another currency if you wanted to either travel, transact, or conduct any kind of business with other members of the European Union, part of the euro area. So exchange was facilitated. Why was that? Because of stability. And that's really as you know, it's the core of the mandate of the ECB, to provide stability, price stability. And the fact that inflation is very precisely targeted for the medium term, and that our monetary policy is aiming and taking all the necessary steps.
This is Bloomberg Television. I'm Bonnie Quinn in New York. The Nasdaq now observing a moment of silence, remembering the 9/11 attacks.
As we commemorate the 24th anniversary of the attacks of September 11th, 2001, please join me in a moment of silence.
You've been listening to a moment of silence at the Nasdaq, remembering the 9/11 attacks. And we'd like to go now to the New York Stock Exchange for a moment of silence there. Moments of silence there at the New York Stock Exchange and the Nasdaq, remembering the 9/11 attacks. We return now to the ECB news conference in Frankfurt.
Then certainly it's for the authorities to enforce the rule of strict conversion. And I very much hope that the authorities do that, because it's the rule, and it needs to be enforced. But we look forward to having you, and you will also, don't forget, being part of this market of 350 million people, your destination, whether it's for vacation or whether it is for investment, has a different face. The cost and the risk is in euro. Thank you.
And for the next question, we go to Olaf Storbeck of the Financial Times. Olaf, please.
Thanks a lot. My first question is on the burden of proof in your data-dependent framework. It felt to many that until June, the burden of proof was kind of that data needed to disappoint or to surprise in one way or another to prevent another rate cut, while now it feels that the burden of proof is data has to surprise to potentially justify another rate cut. Is this kind of a fair assessment from your point of view, or how would you look at that? And my second question is a conceptual question on bond spreads and kind of the European government bond market. So your communication on TPI is pretty clear and says you want to address disorderly, unwarranted market dynamics that undermine the transmission mechanism. How do you think about orderly and justified disruptions to bond spreads that may also undermine monetary policy transmission? I think the TPI doesn't really address this question, and I think it would be good to get some understanding of the government council's thinking on that one.
Well, thank you very much. I was not expecting less from you, but I tell you what resonates with me when I listen to your first question as to, whether it's the burden of proof is here or there to justify up or down or hold or blah. I think there were many governors around the table who, after a good discussion on the inflation outlook, the underlying inflation, the strength of transmission, and the risk. There was a good discussion on risks. After all that, many said, look, let us not over-engineer, please. And I think they have a point. So you give me a chance to actually make another point which is slightly different. But we are very lucky so far, and I hope that stays the same, to have data of which the integrity is not challenged. So the data that we receive from the statistics offices of the member states that are compiled by Eurostat, despite the trauma that we have seen a few years ago out of Greece, but despite that one, which I think has been a lesson for all of us, I think the integrity of the data that we use is very high, and this is valued by all of us. But we take all of that, the data that exist, the projection that we receive, the detailed analysis, the granular details in which we go down to understand underlying inflation, the assumptions that we make on the price of oil, on the price of gas, on price of commodities, the exchange rate, and we factor all that in. And it's on the basis of that mass of data that we try to organize as best as we can to see how it impacts inflation and how it helps us transmit our monetary policy stance that we decide. So I think that I would betray my governors on the Governing Council if I was to enter with you in that rather circumvoluted discussion about the burden of proof, which I was very familiar in my legal days, which was of a slightly different nature. So I think let's not over-engineer. Let's look at all the data. Let's look at all of them when they come, decide on a meeting-by-meeting basis, and make sure that we can continue to be in a good place with the decisions that we need to make at each meeting. Now, your second one. You're very familiar with TPI that you've just mentioned, and we have given a host of details and terms and conditions under which it operates. It's to be found on the press release that we issued back more than a year ago at the time when it came out. And you have to remember always that there is a set of criterias. There is a market assessment, and then there is the decision of the Governing Council. So it's in no way cast in stone, or it's not a straight jacket, and the discretion of the Governing Council always exists. Now, having said that, this is an explanation about TPI, because TPI was not discussed at all in the course of our Governing Council meeting.
The next question goes to Leonid Euxitidis of Handelsblatt. Leonidas, please.
Good afternoon, and thank you very much. Firstly, I would like to come back to the inflation outlook, please. Last week, Isabel Schnabel again explained in detail why she sees the balance of risk tilted to the upside. You said you didn't discuss so much about the topic today, but can you tell us, did more governors today share Isabel Schnabel's view compared to July? Could you share some brief insights with us? And secondly, in July, your communication was interpreted as more hawkish. Were you surprised by that? And do you feel comfortable with the fact that markets now less likely to factor in further interest rate cuts? Thank you very much.
That is 3 questions, so I will discount your third one.
Okay.
2 is already a stretch, but 3, no. As I just said, particularly because we have now agreed on the strategy review, and that one of the changes that we have all agreed is to discuss around the baseline the risks. We had that good discussion of risks. Risks to growth, risks to inflation. We do not ever settle on risk to inflation as to whether it is to the upside, to the downside. We mention a number of factors that constitutes risk to the upside and risk to the downside. And this is all sort of highly technical and subtle, because depending on where you are and where you want to be, those risks to inflation, to the downside or to the upside are either good or bad. So you have to enter into, now I would go back to my previous questioner, that is a bit circumvoluted. But we do have those discussions, and we did have it yesterday and this morning, and it resulted in the risk paragraph that you have in the monetary policy statement, which starts with, and I will quote it for you if I find it right away, risk to economic growth have become more balanced. And I tried to explain why we came to this conclusion as compared with risk to the downside, which was incorporated in our June.
So that is President of the ECB, Christine Lagarde, speaking in Frankfurt. We'll return to that news conference in just a moment, but we do want to bring you these opening numbers because we're higher once again today on the back of CPI data that perhaps wasn't as bad as feared, and on initial jobless claims that, although slightly worse than the estimate, were also perhaps not as bad as feared. So we have our rally continuing. The S&P 500 up 1/3 of 1%. The Nasdaq 100 up a full half of 1%. That halo effect from Oracle's 36% jump clearly impacting the Nasdaq today, although we know Oracle is not a member of that particular index. We even have the Russell 2000 higher, and I do want to mention the euro as well, trading above 117 after that ECB decision. Let's get to some stocks to watch, because we have Delta Airlines reaffirming its outlook for the quarter and full year after seeing a rebound in consumer confidence. Open Door Technologies, look at that, 31% higher, bounding higher after the co-founders rejoined the board and a Shopify executive was named CEO. And then Klarna shares, well, even they have turned around. That'll tell you the kind of market it is, because they were lower pre-market after rising 15% in yesterday's IPO. Well, they've just turned again. Let's get back now to Frankfurt and ECB President, Madame Christine Lagarde.
Exactly what was felt by a very large majority of my governors around the table. And I think I've, as mentioned earlier, repeatedly said that we continue to be in a good place, which does not mean that we are on a predetermined path, because we have to decide meeting by meeting, because we are data dependent, and because we have to face the risks and challenges that are coming. Thank you.
So the next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you very much for the opportunity. So my first question is on the resilience of the euro area economy. How far is this resilience one of the reasons for holding rates unchanged? And my second question, if I may, is still on the good place where the ECB is. Could we also think that it could be a pause in the direction of a rate cut, in the sense that is there a direction of travel, which is an expression you used in the past? Thank you.
Thank you so much. Thank you for your fidelity in attending and in remembering the words that I've used in the past. So you are right to refer to the resilience of the euro economy. And as an example of that, the fact that we had over the first half of 25, 0.7% growth is quite indicative of that resilience. Now, some would argue, no, you had a big front loading in the first quarter and a big payback in the second. And I would submit that this is not actually the case. There was front loading, but the high, unexpectedly high number that we had during the first quarter was partly front loading, but was also partly investment and consumption. And if you look at the second quarter, which is higher than we had anticipated, if you take out Ireland, we tend to take out Ireland not because we don't like Ireland, but because sometimes it's a bit of an outlier for reasons that many of you understand. But if you take out Ireland, contribution of consumption and investment to growth was 0.2%. So good first half. We know that there are headwinds, and there will continue to be headwinds to growth. But I remind you that we have revised upward our growth projection for the whole of 25 from 0.9 to 1.2%. So it's a 30% increase when you think of it, right? But there will be headwinds. And that is reflected in the slight adjustment that we made for 26. We revised growth for 26 by 0.1, and we left 27 unchanged. And we believe that there will be positive for growth that result from the real disposable income that people have and will continue to have, from a very strong labor market. We project labor market to have a 6.1% unemployment rate, for instance. We also believe that the savings that are still very high at about 15% are likely. This is not a given, but there is a likelihood that those savings decline and will therefore help with additional consumption. Added to which, there will be significant investment, and public investment in particular, on the part of those countries that want to increase their military spending, increase their infrastructure spending. The Recovery and Resilience Fund continues to be disbursed until the end of 26, and the military expenses will pick up the baton from there, probably a little earlier than that actually, and will contribute to growth. So those are, essentially the reasons that we see on the upside. There are downside, as I said, there will be headwinds. No question about that. And you can include in that, more trepidation in trade, the strength of the exchange rate and what have you. And this is factored into our projections, by the way. I'm not going to characterize as pause, hold, direction of travel. I think all of that is swept away by the principles that we have agreed, which is to be data dependent, to decide meeting by meeting, to not have a predetermined path, and to really look at inflation outlook, meaning baseline.
Now we want to take you to a moment of silence in observance of when American Airlines Flight 77 struck the Pentagon.
That you, O Lord, would assuage the anguish of their bereavement and leave only the cherished memory of the loved and lost, and the solemn pride for those who have laid so costly a sacrifice upon the altar of freedom. For those of our day who have taken up the cause to secure our homeland, to wield the sword in righteousness to protect our neighbors, grant prudence to execute justice with honor, always mindful we are under your divine gaze. Grant the blessing of wisdom and insight for our leaders, that they may be guided to do your will. Grant humility throughout our land, acknowledging your goodness to us. And finally, we offer supplications for those who currently are deployed, underway, or on duty for our nation. Surround them with the protection of the angels and a joyful reunion with faithful loved ones. In your most holy name.
And my father.
Amen.
Meredith's father. And
please join me for a moment of silence for that minute of impact 24 years ago today.
All right, you've been listening to a moment of silence at the Pentagon. President Donald Trump and First Lady Melania Trump in attendance, marking the 24th anniversary of the 9/11 attacks. You can continue to follow the ceremony on your Bloomberg terminal at Live Go. We return now, though, to the ECB news conference in Frankfurt.
Focus at the moment, as far as the US-Europe relationship is concerned, really focuses on trade and how much more we're going to learn of this trade situation and the repercussions that it will have, taking into account the overall spread of the tariff changes that have taken place and will continue to take place. Thank you very much.
Thank you. The next press conference is on 30 October, not in Frankfurt, but in Florence after our External Governing Council. Thank you very much.
And you've been watching the ECB news conference, but I do want to give you a check on stocks now. We're about 10 minutes into the trading session, and we are higher on the day after economic data didn't pan. So we have the S&P 500 up 0.3%, the Nasdaq 100 up about 0.25%. Now the Russell 2000 is flying away with things. It's up 0.5% right there, those small caps, benefiting potentially from any interest rate cut that we might see next week and beyond. Let's take a look at yields, because we did see just a slight flattening of the curve and yields lower, and they're staying lower. The 30-year yield at 4.66. As you can see, the 2-year yield there at 3.50. The 2-10 spread is just at 50 basis points now. It had dipped below that for a few moments just a little earlier. Well, joining me at the desk is Evercore ISI Chief Equity Derivatives and Quant Strategist Julian Emanuel, the perfect guest for a day like today when we see the Mag 7, all the AI stocks rallying. But Julian, before we get there, I do want to acknowledge that it is, of course, the 24th anniversary of 9/11 and the attacks on that really awful, fateful day. You've never spoken publicly about where you were that day. Would you share it with us now?
Yeah, look, there are very few days and times in a person's life that shaped that person's life. And I was downtown that day as a trader. lost friends and colleagues that day. And so that has stayed with me. But there was really two things, I think, that I take away from that day. And the first, on a business level, as tragic and horrific as it was, as huge a blow as it was to the United States of America and really the world, we remained resilient. Things bounced back. The markets opened a week later. And look at the progress we've made in all walks of life since then. And then, of course, on a personal level, when I got home, the look of joy and relief on my wife's face, and having my two young sons there when so many others didn't return home, is something that stayed with me.
And you've mentioned to me that you were about 500 yards away at the time, working as a trader in Spear Leeds, Goldman Sachs.
Yeah, it's and it was difficult to return to the office, but again, life has to go on, and it does, and it did, and I think we're reminded about the resilience again, given the tragic happenings in Utah just yesterday.
Absolutely. These things continue to keep coming, but there are a few days, as you mentioned, that get seared into the brains of Wall Streeters, and I definitely think that 9/11 obviously takes, the icing on that. Do young traders ever ask you about that day and that time period?
All the time. All the time. We talk about it. I started my career on a stock exchange floor, the American Stock Exchange. And so there is a difference and a novelty, but again, the camaraderie that's very particular to the financial business is something that people understand and share. And, part of developing in the business is learning the lessons and understanding the lessons of the past.
For sure. And we'll always remember, and it's hard to believe it is the 24th anniversary, but there are people still around that can remember and were there on the day, which in itself is a consolation, right, Julian?
Yeah.
Well, I guess let's talk about markets then, and this bull market that just keeps going. Julian, you told us we should be perhaps prepared for a little pullback. Did we already see that pullback, or are there more to come?
Well, so, if you think about the data we saw this morning, if we had seen that data 6 months ago, the markets would be plunging. Okay, jobless claims breaking out of a multi-year sort of sideways channel, and hot inflation data, and so in our mind, there's still a likelihood that you're going to get a pullback. And frankly, every great bull market, and this is a great AI-driven bull market, which we think ultimately goes to 77.50 by the end of next year. But every one of these great bull markets tend to have moments that try and get investors to get off the ride, and we think there's still a possibility you get that before now and year end, but we'd use that as a buying opportunity.
Buy the dip. Well, Julian, I'm going to blow your mind right now, because for the last 2 years I have had this little note on my desk, literally August the 6th, 2023, where you put out a note on generative AI, and you said within 5 years, your base case was that there will be 67% AI adoption. We're just 2 years in, and would you say we're on track to meet your forecast?
We're absolutely on track. All credit to my team who developed the adoption curve those several years ago. We're really on track, and in fact, what we've seen anecdotally and the difference this year and why the rally has been so relentless off of that April low is that companies across industries are talking not only about how they use AI to control costs, but to drive revenue. And that's different and that's bigger.
Yeah. And Julian, I have to ask you, because we have seen just a couple of stocks take most of the buying, let's say, or see most of the buying through this, Nvidia being one of the very large ones. But are you seeing just a little bit of rotation into other AI and AI adjacent stocks in the last few weeks?
Well, you are, but actually when you take the backdrop of it and you think about this bull market in the context of the late 1990s, what's remarkable about it is that market breadth in the late 1990s was actually poor. It was sort of all technology all the time. And in fact, when you look at the advanced declines today, they have been going up in lockstep with the averages, which tells you it may not be as headline fascinating as we are by the Mag 7, but the vast majority of stocks are also participating.
Now, the other thing that you do is you talk about the enablers, the adopters, and the adapters. And, you know, in your research, you and your team basically find that, you know, almost every industry, if not every industry, adapts and enables and adopts to some degree. Therefore, how do you choose which parts of the market you should be in at which particular time?
So what we like to do is look at the companies within the range of industries who've been very upfront about talking about AI. So until recently, it's been difficult to put numbers around, you know, how much they're spending and what benefits they're deriving. So we put a lot of stock in, you know, how many times they talk about it on a typical conference call, and we sort of adjust that for some industries. Obviously, technology talks about it more. On average, real estate talks about it less, but we adjust for that, and we also screen that further by thinking about companies who actually have reasonable valuations in a market that's very highly valued, basis their last 5 years of history, and most importantly, in an environment where when we think about 2026, earnings growth is just going to be an extremely important driver, where their earnings revisions trends are positive.
Now, how much does this story intersect with the interest rate story? Because it looks all but certain now that we're going to get at least 25 basis points next week. Beyond that, what do you see, and does that fuel the fire even more?
Well, it does, and you know, we're in the camp that, like the market, you're going to get somewhere between 5 and 6 25 basis point cuts out to 2026. And the interesting thing about it, and the backdrop again of the late 1990s, where the Fed actually tried to pop the bubble that was really only beginning to form in the second half of 1999. We're not in that environment at all. We don't really see any combination of inflation or growth that would cause the Fed to turn around and hike rates. If anything, you know, given the way the political winds are blowing, you might get more rate cuts than stickier inflation would expect. But that is part of the calculus that drives stocks higher and makes higher multiples something that, you know, we can have a little bit of nervousness, but we want to stay invested.
And a labour market that looks to be, you know, getting incrementally more fragile as we get each incremental data point, and the fact that productivity is increasing partially, potentially because of AI. None of that concerns you?
No, it's, well, the productivity part, again, is one of the positives. I think the labor market, from our perspective, is an evolutionary type thing, because clearly the data this morning was on the weak side. We don't think it's a red alarm flag. So we do think that when you think about what the Fed's going to do next week, there's still a question about whether they're cutting because they can or because they have to. But there's also this idea of the change in immigration policy affecting the labor balance, and we'll have to see how that evolves. But on balance, at the end of the day, you're still near generationally low levels at the unemployment rate.
You know, you talked about the 5-year period, which would bring us to, what, 2028? We're 2 years in. But I'm just curious, you know, is there a tipping point at which, sure, it's almost like the monetary policy transmission mechanism, right? The AI transmission mechanism, we're using it more in the economy, but it's time to move on stocks-wise.
Well, so we're going to be very attentive, again, to that overall level of adoption amongst the rest of industry and the trends that we see, because ultimately, if you get a stalled adoption rate, the hyperscalers will likely be under pressure. We don't see that as an overriding theme right now, but again, to the extent that we get closer to the middle of next year and think about 2027, when right now the projections for CapEx start to moderate, we'll be looking at that closely. But as I said, again, nothing for us to worry about in the here and now.
All right, Julian, see, when I saw that note, I knew it was one to keep on my desk. Julian, thank you so much, and thank you for sharing your remembrances of 9/11 as well. So generous of you. That is Evercore ISI Chief Equity Derivatives and Quant Strategist, Julian Emanuel. Time now for our top calls. Some of the analyst action in focus this morning. First up, Bank of America is cutting its rating on UPS and on FedEx, citing the end of the de minimis tariff exemption for small value packages. Next up, D.A. Davidson cutting its rating on Apple. It's citing the iPhone maker's lack of an AI strategy. The tech giant was also cut at Philips Securities. And finally, Chewy getting raised to a buy at Deutsche Bank following the company's earnings results. The firm says there's more opportunity for revenue growth in 2026 and beyond. August consumer prices then were mostly in line with estimates, but still above the Fed's target month over month at least, and year over year as well at 2.9%. Meanwhile, weekly jobless claims just hit their highest since 2021. Bloomberg International economics and policy correspondent Michael McKee joins me now to discuss the data. Michael, many of these, numbers were in line with estimates. But yet when you dive in a little bit deeper, some things were troubling. Airfares, for example, and, if you want to fix your car, it's going to get a little bit more expensive.
Services prices are the concern for much of the economics world right now because they're still going up and they're not really related to tariffs. I mean, but given where we are, even the headline numbers are a bit of a concern. You look at the CPI and the core, and they're going in the wrong direction, and they're way above the 2% target. So at this point, clearly it's not a free pass for the Fed. Certainly doesn't justify anything in the range of a 50 basis point cut. And it puts into question what happens in October and December at their meetings after September. This is still not bad enough to keep them from cutting in September. But beyond that, we're going to have to see. Some of the things that move the most are things that are going to be political problems, too, for the White House. The president who has declared inflation has completely disappeared. Food at home, that's groceries, up 0.6%. Used cars were up 1%. You mentioned airfares up almost 6%. Airlines have cut capacity. They're raising prices again, and that may continue. Household furnishings, though, video and audio equipment, not too bad, and those are categories that are tariffed. Video and audio equipment going up, but furnishings is where everybody thought we would see a lot of tariff impact, and it hasn't happened yet. Does that happen? That's going to be the question. And as I mentioned, Bonnie, goods versus services, both of them are going up, but at this point, services prices still rising faster than goods, but you can see goods, the white there on the far right, they are going in the wrong direction as well. The trend is not your friend. So for the Fed, something to consider and something they're going to have to try to parse for us when they get to the Fed meeting, because they will probably cut rates, but then have to explain in the face of rising consumer prices why they did and whether they're going to continue.
On the initial jobless claims, it was a 28,000 job difference. So the number came in at 263. Economists were looking for 235. Sure, it's materially significant for each of those 28,000 people, but statistically, is it materially significant?
It would be important if the trend continues. We're going to have to see more than just 1 week, but it was a relatively large jump. And the problem is, once you start seeing that, you might see it continue and pick up steam. But the issue is that was the Labor Day holiday week, and it's hard to seasonally adjust that. So we're going to have to wait another week and see if we get the same level of job cuts or even more to know whether this is something we should be worried about or not.
The balance of risks did seem to be tipping towards the labour market, and the Fed did seem to have some, ammunition to maybe talk about that next week. But after today, can we say the same thing?
Probably. The labor market has been weakening, and the Fed is concerned about that a little more than they are about inflation, because it's something we're going to have to ask them about, and I'll put it this way, because inflation, they believe, caused by tariffs is going to be a one-time rise in the price index for specific sectors. We'll see it, but then it won't continue. However, the worrisome thing here is if service prices still keep going up, then you've got an inflation problem that's not related to tariffs, and they're going to have to think about that, which is why I'm saying October and December, not done deals.
And of course, there'll be the continued expectation of, tariff questions, and also the Supreme Court taking it up on a fast track decision-making process now. So, the Fed chair will have to take that into account at some point as well. Did the bond market overreact in anticipation of this data after PPI and in the run-up to PPI?
Oh, I think you're always going to get immediate overreactions, and we saw. Although it's probably more related to the jobless claims, the initial overreaction with yields falling. And I think that'll come back a little bit. The market has to figure out probably less what the 25 basis point cut is than what the path is going forward, and if there's any change in what the terminal rate is. If that's the case, then you may see a repricing lower if the Fed brings down the terminal rate.
All right, Michael, thank you so much. Looking forward to that next week. That is, of course, Bloomberg's Michael McKee. And coming up in the next hour, Bloomberg's Romain Bostic is at Cantor Fitzgerald's headquarters for an exclusive interview with Brandon and Kyle Lutnick, sons of Commerce Secretary Howard Lutnick. This is Bloomberg Open Interest.
Jerry enlisted in the U.S. Navy when duty called. Upon being honorably discharged, he immediately joined the FDNY to serve and protect the city of New York. 24 years later, 2,900 innocent victims, countless post-September 11th illnesses and death, and casualties of the military here and abroad, too numerous to count, all as a result of terrorism. Hopefully, our government will enable us to get the justice our loved ones deserve. Our government shows its strength on the world stage, and we are confident those responsible for the attacks will be brought to justice. In 2001, the world echoed, "Never forget." In my opinion, the victims will have died in vain if those responsible are not held accountable. As always, may God bless our first responders, post-September 11th victims, our military here and abroad. May God bless us freedom of speech, and may God bless America.
And my brother, Kevin L. Bowser from Philadelphia, Pennsylvania. We will never forget him and all of our loved ones we lost that day. This is history that brings us all together. History is the heart and soul of our lives. We must protect it and never forget it. God bless America.
Jeffrey Brian Gardner.
Thomas A. Gardner.
William Arthur Gardner.
Frank Garfey.
Rocco Nino Gargano.
James M. Gartenberg.
Matthew David Garvey.
Bruce Gary.
Boyd Allen Gatton.
Donald Richard Gavigan, Jr.
Peter Allen Gay.
Terrence D. Gazzini.
Gary Paul Guidel.
Paul Hamilton Geyer.
Julie M. Geis.
Peter Gerard Gelinas.
Stephen Paul Geller.
Howard G. Gelling, Jr.
Peter Victor Genko, Jr.
Stephen Gregory Genovese.
Elaine Gentile.
You've been listening to the observance of the fall of the South Tower in Lower Manhattan and the reading of some names. We take you now to a moment of silence near Shanksville, Pennsylvania. That moment of silence to observe the crash of hijacked Flight 93.
A wonderful son, brother, father, and superior pilot, my cousin, Captain Jason M. Dahl.
Joseph DeLuca. Patrick Joseph Driscoll.
Welcome to our Bloomberg audiences on TV and radio. I'm here at Cantor Fitzgerald's headquarters in Midtown Manhattan for their annual charity day to commemorate the September 11th attacks that happened 24 years ago and the initiatives that grew out of it, the philanthropic initiatives that grew out of it under the tutelage of Howard Lutnick and now being taken forward by his sons, Brandon Lutnick and Kyle Lutnick, the chairman and executive vice chairman of Cantor Fitzgerald. I'm pleased to be with you today, and obviously it is a day that I think for both of you, while still very young at the time that the attacks happened, there's a personal story here that runs from your father through you and most likely to the people who will come after you. Talk about that day, Kyle, a day that we all remember, a very famous photo with you and your father taking you to kindergarten.
Well, Romain, thank you so much for being here. We really appreciate it. Before we dive in, we want to make sure we call attention to the terrible events that happened yesterday. Charlie Kirk was a good friend of the family, and our thoughts and prayers go out to the Kirk family. It really was terrible what happened yesterday.
Definitely was horrible, and our prayers with his wife and young children.
So just to set things in perspective, 24 years ago today, I was standing outside my kindergarten with my father. It was about 2 minutes before the planes hit the tower. And I still have some recollection of it, being in the kindergarten and my dad having to run out to go to the building. You know, on that day, we lost 658 employees on the 101st to the 105th floors. And it was really, really terrible that we keep that energy with us here today.
We lost our Uncle Gary Lutnick, who was 36, our dad's brother, our godfather, Doug Gardner, our dad's best friend, who was 39. And it was really just, the worst day in history. But what you really see behind us is, the Cantor trading floor, and this is what really gets us through the day. After the trading day today, we are going to be at the 9/11 Memorial with our community, our friends and family. It doesn't represent the almost 3,000 lives that were taken that day, but this Cantor community is really close, stayed really strong, and our employees are what really, keep us together and get us through the day. All money raised, a day's revenue will all go to charity today, and it's really, really just the best way to turn something tragic into something beautiful.
When we talk about what started all this, Howard Lutnick putting down $1 million to effectively start this turning into an annual event. You bring in celebrities who help demand the phone banks, raise money. What types of charities are you primarily focused on right now?
It's more than 150 charities today. It changes every year. We have celebrity ambassadors that come represent charities, and 24 years later, the Cantor Relief Fund was started to take care of those 9/11 families. Our father promised to give 25% of all of his profits for the first 5 years and pay for the family's health care for the next 10, which ended up being a combined $180 million promise that he kept and fulfilled for the families.
And we have a continued promise here today where any children or anyone related to anyone that was lost in the towers on that day have a standing job offer here at the firm. And we have 10 individuals here working at the firm today. And it's really incredible that we get to help them either continue their career here or launch their career into the financial services world.
24 years, and now this company that you now helm, as well as the charity, is at a bit of an inflection point. You've taken over for your father as the chairman and executive chairman of Cantor Fitzgerald. You've seen how much it's been built back up since 9/11. What did you have, a couple hundred brokers back then coming out of that, and you have 2,000 now.
And today, across the three companies, Newmark, BGC, and Cantor, we have about 14,000 employees globally.
How much do you expect that to grow?
I expect it to grow, for the time. The joke that Kyle and I make is that we have no political aspirations, so we're going to be in our seats longer than our father was in his. He was at Cantor for 40 years, ran the firm for 30. But it's really a testament, to the leadership, our dad built here and installed here. These guys, really take a lot of the weight off our shoulders, and we're, super honored and glad to be a part of an incredible executive team.
This year, you've had a pretty good run when it comes to underwriting. Last time I checked, at least through August, you were the #1 underwriter for U.S. global IPOs. You've been involved in Bullish and eToro. I believe you have a couple others potentially that could price this week, like Gemini and Legence. What's driving that resurgence?
Our father always said, when the market's cold is the perfect time to invest. And we've put a lot of time and energy into growing our investment bank under the leadership of Sage Kelly. And doing new offerings has really been sort of a good place for us, hitting the markets hard.
Yeah, we've doubled our investment bank size over the last 18 months. And again, I really give credit to the team we've built here. You know, we're a private investment bank, and that's very rare in Wall Street. So when we commit to an industry, we commit, skate to where the puck is going. You know, I think, our crypto efforts really shown that. It's our ability just to commit to the sector before everyone else, and you're just really seeing it pay off. And again, these guys are everything.
And you anticipate keeping this private?
I do.
What's the advantage of that?
The advantage is when you're a great company, there's no need to go public. Public is out raising money and a few other items. And I think for us at Cantor, we're really special, private, and we get to commit to something. We get to move fast. We get to be mobile and be efficient. Less bureaucracy. But again, we have an incredible leadership team, and we run like a public one, but move like a private one.
And we should point out, I mean, right now you have 3 co-CEOs, one who heads equities, one who heads fixed income, and then, as you mentioned, Sage Kelly there with the investment banking business. Do you plan to keep that 3-tiered co-CEO structure?
There are 3 superstars, so I see no reason to change it.
Yeah.
SPAC deals. You have, Cantor Fitzgerald has always been a leader in that space, and we've seen a resurgence in SPAC deals. In fact, when you look at the number of IPOs we've had this year, more than half have been SPACs. What is actually driving that resurgence? Is that a regulatory easing, or is that just maybe just more risk appetite out there?
Cantor has always been a big believer in SPACs. Before the SPAC boom in 2021, we were the #1 player in the space. During the boom, we fell down off of #1 because a lot of companies were going public. And now post-boom, we're back to being the #1 player in the space. It's always been an industry we've thought about and cared about, and always brought tremendous value. And you're seeing it again today. And I think what it allows is for us to be creative and thoughtful in how we help companies. And you've seen that with 21 Capital and BSCR to Bitcoin Treasuries, and hopefully a few more.
What's the health of the SPAC industry today relative to what it was after we came out of that boom in 2021, 2022, and things started to taper off?
I think it's very strong. Look, I can't comment on how long an industry lasts, but I really believe in our franchise, and when you see it, our SPACs tend to trade above 10, and that's because they believe that we're going to find the right companies and do it in the right way. And I think so far we've proven it, and I hope to keep growing. And again, our guys, our leadership, they do an incredible job of really seeing that through and executing at a very high level.
We do a really good job of attracting great talent here. And so again, it really is a testament to the leadership and our guys that are working the floors and the phones every single day, hitting it hard and getting us opportunities.
How hard is it to find talent? Or I guess more importantly, how hard is it to sort of fend off your competitors from taking that talent as well? I know Sage Kelly has talked a lot about expanding the IB business and also maybe changing the pay structure, or offering the pay structure, I should say, that's different than your competitors.
I think talent's always tough to find, but when you have the right culture and the right environment, it becomes a lot easier. I mean, again, this crowd today, these guys are not taking a day's pay, and they're giving it all to charity, and that shows something. That's 24 years ago. Some of these guys weren't born yet. We were young. To be honest, I don't really remember the day, but I wear this 9/11 bracelet every day. Been wearing it for over 10 years. It says honor and remember, and I think that's exactly what we're doing today. We're honoring those we lost and remembering them.
Part of the big issue, or the crux of why this day is so important to us is of the 658 loss, you had a lot of pairs of family members. You had brothers, you had fathers, sons, mothers, and aunts, all working here on that day. And our father would always say, you have a spectrum of friends. You've got the friends that you go out with and they make you laugh really hard. You've got the other set of friends that you find are really intelligent, you can have good long conversations with. And we want to try to hire those types of people. And so that's sort of why the culture here is really incredible, is you want to show up and you want to work with people that you like and people that you get along with. And that's sort of the culture that we're trying to drive here.
I mean, how much do you interact with your father on a business basis?
Not at all.
No.
It's a little sad actually, because we used to see him 12 hours a day every single day, and now I see him for a weekend, but we still talk. I mean, he's even with everything going on, he's still an incredible father.
Has his connections to the Trump administration helped your business?
No.
Not at all?
I mean, it's not supposed to help, right? Like we are a franchise regardless of his seat. You know, we are a business that's built regardless of where he is. I mean, look, when you lose, you know, Howard Lutnick in the business, there's obviously a gaping hole, but you know, we together, along with our executive team, are trying to fill that hole, and you see it today. I mean, we're having an awesome year, and you know, honestly, we're hoping today's a record charity day.
Yeah, we feel good about that.
Have there been conversations, though, about how to avoid potential conflicts of interest, given your father's role at the Commerce Department? Any firewalls set up just to sort of make sure that everything sort of stays above board?
I mean, I think we are as perfect and you know, ethically compliant as one can be, and our father's not a guy who takes risks. So I think from both sides we keep that very clean and sharp. But you know, our father is, you know, when you get called to serve for your country, you take the call, and we're incredibly proud of everything he's doing.
Very, very proud of him. Yeah.
When it comes to some of the policies coming out of Washington, there has been a deregulatory bent to that to a certain extent. And this is particularly evident in the world of digital assets and crypto. You've made a couple of big deals already. I think you mentioned 21 Capital just a second ago, Brandon. Obviously, the deal with Adam Back, which I believe should be coming to fruition by the end of this year. And of course, you've been either an underwriter or an advisor on several crypto-related IPOs and SPACs.
This administration really cares about America. I think they're very, you know, just like they are and we are very bullish on the digital asset industry. And you need to give these companies a regulatory framework to survive, to flourish. You know, under the past administration, that didn't really exist. And this administration, you know, is smart, thoughtful, and caring, and they really believe in this industry. And so do we. So does Cantor. And they're just giving them a place to thrive, and our job is to help them out.
Just yesterday, I think the OCC commissioner, the Office of Comptroller of the Currency, was at a CoinDesk event, and he kind of talked about this idea of trying to sort of remove some of the barriers between, I guess, the new digital world and more traditional banks and asset managers. The idea that there was sort of a regulatory friction in the middle of that. Are you confident that maybe we will see more of a melding of traditional finance and new finance?
I mean, you'd imagine. Look, I think, you know, the digital world can bring a lot to the traditional finance world. You talk about, you know, payments in seconds, frictionless. You talk about remittances. You talk about, you know, the tokenization of, you know, real-world assets. You know, being able to trade 24/7. I mean, these are things that with the technology we have should happen, and I think this industry is going to, you know, be hugely successful. And again, big believers.
What is sort of the model, though, that you look for as you pursue digital assets? I mean, are you primarily looking at it as a buy and hold from a treasury perspective? Are you looking at it more as the underlying technology and what's that could sort of do in sort of reducing some of those frictions?
I mean, we're an investment bank, so our job is to, you know, meet great companies, meet great leadership, and help them accomplish their goals. That's really what I look for. But that's the same from healthcare to tech to, you know, FIG to industrial to digital, right? Like, we look for great leadership, we look for great teams, we look for great business models, we look for, you know, incredible company, and our job is just to partner and stand next to them and help them accomplish their goals.
You mentioned the idea of remittances and really just the idea of the transfer of money. Stable coins have finally kind of made it into the spotlight. How involved are you there? And more importantly, where do you see it going? Do you think that it will broaden out beyond just some of the small players we have, and it will become much more institutionalized within corporate America and even maybe potentially within governments?
I mean, we hope so. You know, obviously we have a very close relationship with the largest stablecoin in the world, Tether. You know, they're an incredible company run by incredible guys, and you know, everything they've been through, they deserve the world. You know, I think the concept of stablecoins is clearly something that should exist across the world. I mean, you allow people in emerging markets to gain access to the U.S. dollar. It's dollarizing the world. It's dollar hegemony, and that is really incredible for the United States of America.
With regards to tokenization, Vlad Tenev over at Robinhood, he basically says this is the future one way or the other. How does that look paired up with traditional finance and the traditional way that we would buy a stock or a bond or other asset? Is that going to coexist side by side, or is that potentially a situation where tokenization would replace the more traditional system?
I mean, I think it's a bit strange and should be fixed that, you know, if a huge event were to happen on a Saturday or a Sunday, you know, Bitcoin would go up and down, but you know, the classic traditional stocks, you have to wait till Monday morning. That is something that should get fixed. So I agreed in the tokenization of being able to trade 24/7, but again, you know, that's not really our perfect stratosphere.
I do want to get your thoughts just on the state of New York City. Obviously, you have a big real estate business through Newmark. We're going through a big election, mayoral election here in New York that could reshape policies towards the real estate industry. Have you had a chance at all to meet with any of the front runners in this mayoral election?
You know, I think we've kept a little bit of a distance so far, but you know, we love Mayor Adams, we love Cuomo, Dani. We have not had the pleasure of meeting yet, but I think we have a lot of views that are different to Dani. You know, we're a very pro-Israel group here. You know, especially on 9/11. You know, talk about the terrorist attack. We talk about if they had the chance to do it again, would they? And I think that's something that's really meaningful for us today to remember and never forget. And I haven't had the ability to speak to him, but.
New York is really an incredible city. It's a very strong and resilient city, and I believe cities have live energy throughout them. They ebb and flow through different parts of their timeline and their growth. Yeah. And New York is very strong and resilient, as we've seen through 9/11, as you can see on the trading floor behind us. And so whatever happens come November, New York will be fine.
Do you have faith long-term in the office market here in New York City?
I'd buy and hold on New York for sure.
Buy and hold on New York. Just final question here, and this really has to do with the idea of where you see sort of the biggest risks going forward, not just for yourself, but really overall for markets, and how you see maybe Cantor fitting into that and maybe potentially addressing it.
You know, I think the biggest risk. I don't honestly see too many risks, to be honest. This is an administration I really believe in. And when you have the smartest people in the room, the smartest businessmen in DC, things get done. Obviously, we think the world of our father, but that whole administration, the president, he's really, made promises and stuck to them. And, I'm incredibly bullish and incredibly appreciative for their service and all the work they've done. And even more appreciative for the guys behind me. So,
one of the biggest projects that we're thinking about is the data center space and the energy grid of America. And one of the biggest risks that I see is people moving too quickly or making rash decisions to try to get ahead of the curve early and often. And so, what I would say is take a second, breathe, and come and talk to some of the most intelligent people on Wall Street and see if you can get a second or third opinion before you make your move. There's so many variables and so many factors when making any decisions in any of these markets, and making sure you get your second and third opinion is crucial.
Kyle, Brandon, really appreciate you having us here at your headquarters in New York. Thanks to both of you, and wishing the best of luck here on the 24th anniversary of the 9/11 attacks and the charitable efforts that have grown out of that. A positive development.
Thank you so much for being here.
And I'll toss it back to you in the studio, Bonnie.
Romain, thank you so much. That is Bloomberg's Romain Bostic on site from Cantor Fitzgerald with Kyle and Brandon Lutnick. Now let's get a check on markets. They are roaring today. We even hit an actual record on the SOX, the Philadelphia Semiconductor Index, earlier, but it really is across the board. I mean, we're only talking about 75 companies that are lower in the index right now, and Centene is the top performer. It's up 12%. The insurer said earlier on that it had data that showed its Medicare quality ratings or star ratings in line with its company expectations. So really this is about sentiment. We have practically every single area of this market going higher. I want to point out that the S&P 500 is up more than 0.5%. We have the Nasdaq 100 up 1/3%. And as you can see, the 10-year yield at 3.99. Yields have been drifting lower all day after the CPI data came in. Month over month, just a tiny bit hotter than expected, but perhaps not as bad as could have been anticipated. But let's bring in Christine Aquino now. She's Bloomberg's managing editor of Markets Live. She's joining me at the desk. Christine, I mean, if you look at the overall indices, we're still sort of just grinding higher, but this is a market that's very ebullient today.
Yeah, absolutely, Vonnie. And you can see the animal spirits are everywhere, really, right? And it's a market that has a little bit of something for everything. If you're a stock bull, you're, of course, rejoicing at the fact that the AI trade seems to be back on the table once again. Oracle, of course, put that back on the map this week in a big way. And so stock investors very happy to ride that rally. And then, of course, when you look at the bond market, we're seeing gains as well because of the prospect that there's really very little to stand in the way of a Fed rate cut next week and potentially even more towards the end of this year. So it's a rally for everyone. It
really is. I mean, even Synopsys rebounding more than 8%, and it dived or dove 36% yesterday. We even have Micron up 8% because, I guess after Oracle's earnings, anything could possibly happen when they report September 23rd. What could derail this?
Well, Dani, I guess it really is down to the Federal Reserve meeting now next week, right? And it all depends on kind of their characterization of how the economy is going. At the moment, there seems to be a bit of a Goldilocks narrative that we're experiencing where the data is slowing, particularly on the jobs front, but just enough to encourage the Federal Reserve to consider that rate cut next week, possibly more into year end. And that's something that is cheering most investors. But then the problem is if they do point to an even more dour outlook heading into next year, right? Because that's where you kind of tip the balance between a slowdown that is manageable to potentially a recession. That's not really something that's currently on the market's radar and therefore could surprise.
It is all in your hands, Fed Chair Jay Powell. That is Christine Aquino from our Markets Live team, and thank you, Christine. Still ahead, we're going to be taking a look at the regional banking landscape with the CEO of Customers Bank. This is Bloomberg Open Interest. This is Bloomberg Television. I'm Bonnie Quinn in New York. Today marks the 24th anniversary of the 9/11 attacks. Memorials are being held to honor the victims, first responders, and all of those around the world impacted by those attacks. We now head to the next moment of silence. This moment in observance of when the North Tower fell in Lower Manhattan.
Griselda E. James.
Mark Stephen Jardim.
Amy Nicole Jarrett.
Muhammadu Jawara.
Francois Jean-Pierre.
Maxima Jean-Pierre.
Paul Edward Jeffers.
John Charles Jenkins.
And my brother, Thomas Harold Bowden Jr. Tommy, I can't believe that you've been gone for 24 years. Sometimes it feels like a whole lifetime ago, and sometimes the memories are as fresh and painful as if it all just happened yesterday. What I do know is that you made a tremendous impact on so many people while you were here, and that your memory lives on through the lives of the people that you touched. We miss you and we love you.
And my godfather and uncle, Richard S. Gabriel. We love you and miss you. Your spirit lives on. And I know that my Uncle Richie would want me to give a shout out to all the first responders who gave their lives on that day. For the longest time, we thought.
All right. You're watching Bloomberg Television. I'm Bonnie Quinn, and we do want to bring you now to an interview with Jane Fraser, Citi CEO. She was speaking with Jumana Bersetchi, our Dubai anchor, and she had a lot to say about banking and the future of interest rates. Let's have a listen.
You've got to look at the collective impact of the tax policy, what's been happening with tariffs, and indeed the increasing deregulation that we're seeing. And they work together as a package. I think the most important piece for a corporate, clarity. We hate uncertainty. We like clarity. And our client base now is really starting to act with more confidence now that we've got clarity on those three fronts. So active in the capital market arena, in financing, much more active in investing, less sitting on the sidelines. And M&A has been very, very active indeed, as we talked about.
Yeah.
And on the consumer side, pretty robust spending through the summer. And we saw that really across all categories, helped a bit by lower gas prices. But the consumers being fiscally responsible, being more mindful around some spend, but still the spending levels were very pleasing.
So the momentum was pretty strong across all lines of your business in the second quarter. Of course, I don't want to precipitate the upcoming earnings, but Can that momentum continue into the end of the year, just in terms of, what you're seeing in advisory, in deal making, and in trading? Because it was a very strong quarter for trading as well.
It was exceptional for us on all fronts. I still see very strong pipelines. I see high level of engagement from clients. I see a sense of urgency as well, given the speed with which industry structures are changing, and there is still growth opportunity. I think growth will be a notch lower. We're keeping an eye on the labour market. It's a low churn market. So not everything is rosy, but we don't see a recession on the horizon.
And that was Citigroup CEO Jane Fraser speaking about her outlook for the US economy. And we're going to stick on this theme now. Joining us is Sam Sidhu, CEO of Customers Bank. Now, that's a mid-sized US regional bank, manages roughly $20 billion or so in assets and based in Pennsylvania. Sam, thank you so much for joining. So Jane Fraser sees growth a notch lower and is definitely keeping her eye on the labour market. How are you in Pennsylvania at Customers seeing the outlook?
Well, thank you so much for having me, Bonnie. And we echo the sentiment that Jane is seeing on a much larger national as well as global scale. I think that the banking industry is anticipating, a potential rate cut. Next week, our customers are anticipating a bit of a rate cut. It's gravitating towards about a 25%, but there is a bit of a growing probability of even 50, which I think would be welcomed given this sort of higher for longer rate environment that we've been in. After there was an administration change last year, we as a banking industry were anticipating the second half of 25, which is what we're sort of starting in right now, would be stronger, and we are seeing those pipelines build up.
Yeah, what does it mean for your customers and for you, running this bank where a lot of your revenue comes from commercial loans, to have rates on the decline?
Yeah, well, on one hand, the asset side of our balance sheet has benefited, meaning our loan yields have been higher in a higher rate environment. On the opposite side, our deposit costs and our funding costs have also been higher and experienced a lot more competition. What our customers, are seeing is they're more focused on that first comment, which is they'd love to see lower interest income for Customers Bank, which means lower interest expense for them. I think that the tax reform, the change in the administration, a lot of the sort of regulatory reform is trickling through the overall economy, and we're seeing very, very good demand and a lot of good confidence and optimism.
Sam, are you seeing any flashpoints of credit deterioration? Because from time to time, we get these pieces of data that would indicate that perhaps delinquencies are on the rise, or that consumers are maybe not paying, their loans back. And of course, you had the tricolor situation, which might be slightly separate, but, there is an indication out there that there are fragilities.
Sure, absolutely. Higher rates can also expose some of those vulnerabilities, like the fraud that you just described. But what I would say is what we have seen and continue to see is incredibly strong credit performance. And I think we're thrilled to be able to say that as an industry, but also at the bank. We've seen our non-performing loans, our watch list loans, our charge-offs all decline in sort of recent months and quarters. To put that in perspective, just 13 basis points of commercial charge-offs recently at Customers Bank.
You acquired some venture backing portfolios, and I'm just curious, after the failed Signature Bank, that was ripe for the grabs. Are you looking to do more of that? Is there an effort that's panning out with regard to venture backing?
Yeah, sure. We are the 80th largest bank in the country. We sort of need, we know we can't be everything to all people. We can't be a mini Citigroup like your last guest and Jane Fraser. So what we do is we choose specific lines of business where we feel we can be at least the top 10, if not the top 3 to 5 in the country. That's how that venture banking portfolio fell in. It was sort of strategically important to us. It allowed us to accelerate, go from early stage to late stage, allowed us to go from just sort of more Northeast focused, more software focused, to a bit more of a national presence. And so that was one off. It allowed us to really build that top 3 to 5 business in just a span of a couple of years. But our acquisition, our growth strategy is more focused on penetrating our customers more. 80% of our customer deposits we'd like to come from existing customers and referrals and growth of our customers. Having said that, we are bringing on a lot of teams. That's sort of where we've been quote unquote acquiring. We give them the single point of contact delivery model, incentive compensation model, and they bring their relationships and books, and we don't give them any bureaucracy or politics.
You've also been banking for crypto firms for quite some time. I'm curious if you've experienced any problems there, or if the regulatory environment getting a little bit more benign, let's say, for the crypto firms has been of any help.
Yeah, it's a that business falls in it's a payments business that we started back in 2021 and really ramped up in 2023. To put it in perspective, last year in 2024 we processed $1.5 trillion of payments related to our digital asset customers on what we proprietary built called the Cubics platform. So post the election, we have seen a real increase in customer activity. I think regulatory clarity that you touched on is incredibly important. It's helpful for us, it's helpful for our customers, but it's also helpful for the consumer and the U.S. economy. And so we are seeing this business sort of from our existing institutional customers grow. To put it in perspective, 25% of our deposits and our customers come from traditional finance customers who are in the digital asset trading and settlement space.
Speaking of, that area and what we know of past failures and so on in that area, I'm curious as to what you're doing in terms of any balance sheet repositioning now that you know that interest rate cuts are probably coming next week, and if there's any way you could lock in higher rates.
Absolutely. We as a bank really focus on interest rate risk management. We want to build a bank that is resilient in all rate scenarios. And that's meant that we've been focusing on some hedging and activities. We've actually, despite this higher for longer rate environment, have been increasing our net interest margin, increasing our earnings by 30%, year over year. To answer your question, sitting where we are today, we're at about an 80% loan to deposit ratio. We're sitting on almost $4 billion of cash. And I think that provides us a tremendous amount of flexibility and most importantly, provides our customers the support that they need today and they might need in the future.
Well, certainly investors rewarding the stock up 40% year to date. Sam, thank you so much for joining us. That is Customers Bank CEO Sam Sidhu. Coming up, we'll catch up with Bloomberg's Dani Berger. She's alongside Ian Charles, Arctos Co-Managing Partner and Co-Founder. This is Bloomberg Open Interest. Turning now to private equity, Arctos is one of the best-known sports-focused funds in the world. It owns stakes in more than 20 franchises, including the Golden State Warriors, the Los Angeles Dodgers, and the Pittsburgh Penguins, also the Chicago Cubs. The $15 billion firm also provides capital and advice to other private capital companies. Bloomberg's Dani Berger joins us now from Dallas alongside Ian Charles, Arctos Co-Managing Partner and Co-Founder. Dani.
Bonnie, thank you so much. And yes, I am joined here by Ian. I am so thrilled for this conversation. Ian, great to see you. Thanks for coming into the studio.
Great to be here.
So Bonnie mentioned some of your business. On one side, you have the sports. On the other side, you work with other private capital firms. I want to talk about that and the liquidity solutions you provide. I know it's your keystone business. What exactly are you doing, and why is now the moment to be helping some of these companies?
Well, we call that strategy the keystone strategy because the keystone species is the species in an ecosystem that helps everybody thrive. So what we're trying to do is help great private equity firms thrive on their journey as a business. A lot of people don't really understand these businesses. The leader of a private equity firm is typically called a managing partner. And most managing partners, with few exceptions, are deal junkies that got pissed at their last job, so they left and they became a founder. If you're good and you get a little lucky, you raise a few funds, all of a sudden that founder is responsible for a firm, like a real proper business. But leading those businesses has never been harder than it is today. There's a tremendous amount of pressure in private markets, competitive pressure, consolidation, and I would argue that leading a private equity firm has never been harder than it is today. We help the entrepreneur that is the managing partner on the journey of leading these firms. That's what the Keystone strategy does. We provide growth capital and strategic advice to the leaders of great firms.
Well, just to that point, it felt like only a few years back it was this environment where everybody and their mother was launching a private equity firm. You're working again with people who have done just that. Is that period over where you can say people can grow up and really get a firm going? How selective are you in choosing people?
Well, those are two different questions. We're very selective in who we partner with. We have some of the most sophisticated software in the world at assessing a manager's skill, their ability to generate non-market returns, what everyone in this industry calls alpha. We want to partner with alpha-generating managers who have some really important organizational objective that we can help them unlock. That is the focus of the Keystone strategy. Your other question was, are people still leaving to form firms? That's a completely different answer. this year there will be fewer new firms formed than at any point in my career, less than 2009. Starting a firm is risky enough in normal times. In the current environment, it's more challenging than it's ever been. And so what you have is new firm formation falling, consolidation where bigger firms are buying smaller firms, specialist firms. And as a result, for the first time in my career, the number of active general partners, which is what the industry calls the investment managers, the number of active general partners has been falling 2 years in a row. That's never happened in the history of the asset class. So client selection, customer choice is coming down.
Does that mean we're about to have just a bunch of firms that are just kind of struggling along from here, kind of the zombie firm phenomenon?
So nobody really talked about zombies for the last 10 years. It was a topic du jour kind of 2012 through 2014, and then people stopped talking about it. You had zero interest rate policies, you had market appreciation, and the machine started to run pretty hot again. People will start talking about zombie firms because the fundraising environment is so challenging today. Firms are having a really hard time maintaining their growth trajectory. And as soon as you start to lose growth, you start to lose your talent. And so we think 2025 will be the single largest creation of zombie firms in the asset class history. And we define that as a firm that hasn't raised capital from the institutional community in at least 7 years. So that will be a theme that starts to emerge over the next 24 months.
I'm sure you're getting more phone calls saying, hey, can Keystone please help us out here?
We want to help everybody if we can.
So that's the Keystone side of the business, but then there's also the sports side of the business. And I think it's fair to say that you grew from relative obscurity to become the dominant player here. You're basically in every single major league sports. You're in Europe, you're in F1. Yep. Where did that growth come from?
Well, when we started the firm 5.5 years ago, the founders were a mix of operators, innovators, entrepreneurs who happened to also be investors. But some of us spent our careers helping the managing partners of other firms unlock their most important thing. So that collective learning has allowed us to build a really unique firm of one serving the sports industry. Our mission is to help great operators who have great assets in great markets unlock their vision with growth capital and liquidity. There is no firm that looks like us today. We're, like you said, we're invested and approved in every single major North American sports league. We're the only investor approved in all 5 big North American leagues. We're the largest investor in women's sports. We're a dominant player in international sport. And our firm has all of those attributes, but it also has some really unique capabilities around data science. We have the largest data science business serving this industry, a capital markets group to help with liquidity, and a value creation team to help our owners unlock their
What are you
vision.
doing on the data science side? Because you mentioned you have other competitors in here. Is that kind of like the secret sauce, what makes you different from Ares, Sixth Street?
Well, our data science business serves both the private markets industry and the sports industry. And what we're trying to do is build tools, research, and software that helps us understand where the market and industry is going and whether or not an operator is excellent. And so in the Keystone strategy, that's about identifying alpha creation. In sports, there is a signal that looks like alpha, but it comes from 2 different parts of the sports business. Inside of a sports club, there is a group that makes decisions around players. It's called team operations. People call it Moneyball. The job of that group is to try to create the highest quality roster given the amount of money you can spend within the league's limitations. We call that skill hope. But there's another group inside the business called business ops, and their job is to take hope and turn it into revenue or brand equity. Sometimes you don't want to monetize hope. Sometimes you just want to create a better experience for the fan and draw them in for their entire lifetime. And so some of these operators are excellent at team ops. Some of them are great at biz ops. What we're trying to do is help owners get great at both and help them unlock their vision for that live entertainment platform.
And there are probably some people listening to and saying, that sounds really well and great. But at the end of the day, just because of how these leagues are set up and the way they allow investments, you're taking minority stakes. Therefore, minority stakes, how much change can you really impact? How willing would a team be to listen?
So I actually love this question when we talk to investors, because if you're a control buyout investor, you can make the private company do whatever you want. If you don't have control of the business, you have to offer services that are so good, they want to use them. And so our mission is to be the best possible partner we can for that operator, however they define it. If they're firing on all cylinders and their business operations are excellent and they just want us to be a passive partner, we can do that. But if they're trying to build a new venue, optimize the venue they have, create a fan engagement zone around the venue, buy other teams, we can help them unlock that vision and create value, but they have to want us to engage. And I actually think that creates a higher bar for us to invest in the firm and our capabilities.
There's also this other argument, and I'm sure you have heard it, that valuations have just been going up because we're in a bubble. And perhaps that's why, at least for now, that sports investing is successful. I know the owner of AC Milan, Redbird founder, had argued that just earlier this year. Is he right? Are sports valuations, especially in North America, in a bubble?
Well, that's a strange argument for someone who owns sports to make. When I hear that, it typically comes from two different places. The first is just a lack of information. Some people don't understand the fundamentals. They don't have enough data to understand these businesses. The other place that this comes from is insecurity. There's a bunch of people that would love to invest in these premium leagues and these premium assets, but they don't have the regulatory approval to do so. But if we talk about fundamentals, over the last 5 years, since institutional capital has been allowed to invest in this space, the big four North American leagues have appreciated their club values at about 14% per year, which is less than the S&P 500. So there's nothing like magical or phenomenal about this performance. What is unique about it is that that performance comes with very low leverage, lower negative correlation to traditional and alternative asset classes. And so if you just owned this beta factor in a diversified portfolio, it's been a risk reducer and a return enhancer. And our job is to provide that beta to the client with alpha. And we're a firm of one with a bunch of unique capabilities to do that.
Just to your point of someone making these comments that is invested in sports, just because for a lot of people this is a new area. A lot of firms for the first time are launching sports funds. Do you think there's some naivety in this industry? Do you think some people getting into this don't fully understand the business that they're in?
Well, I think the thing that we tell investors who are thinking about investing in the sports ecosystem is that for most of the sports ecosystem, sports data, sports venues, youth sports, sports gambling, sports agencies, those are simply TMT businesses. There is no competitive barrier to entry, and any private equity firm that has dry powder can compete in a competitive auction to buy those assets. And so you have the same kind of peak pricing that's happening across private equity in that broader sports ecosystem. Where we focus is in the premium assets, the clubs and the leagues that own the IP that really matters. The National Football League, the NBA, the National Hockey League, Major League Baseball. Those leagues have very strict regulations on who can buy equity in their clubs. And the number of firms that have been approved to do that has not really changed at all in the last 4 years. And so there's tremendous competition inside the broader...
Just a minute, but why is that? Why hasn't that changed? Why aren't there more people?
There are strict rules around conflicts of interest within your portfolio broadly. If you want to invest in the NFL or the NBA, you can't own a player agency or a sports gambling business. Your senior leaders can't personally own stakes in teams. You have to have raised, not announced, but actually raised minimum amounts of capital just to apply for approval. And those thresholds are $1 billion, $2 billion. And so just because you announce a sports fund at 750 or 500 or $1 billion, the target size in the most difficult fundraising environment I've ever seen, even if you raise your target size, you're not going to get approved by these leagues. And so those funds tend to talk a lot about and focus on that broader ecosystem where there is no competitive barrier to entry.
All right, Ian, I'm afraid we're going to have to leave it there. This has been so fascinating. I think we could probably do this all day. So we'll have to talk again soon. Ian, thank you so much. And Bonnie, with that, I'll send it back to you. That is Ian Charles of Arctos.
Fantastic. Dani, thank you so much. That's Bloomberg's Dani Berger there with, as she said, Ian Charles of Arctos in Dallas. Let's get a check on these markets because the Dow has surpassed 46,000 for the first time. We're up 1.2% on that particular index. The S&P 500 up 0.2%, and the Nasdaq 100 up 0.4%. But individual stocks are moving like crazy. Micron is up more than 8% in anticipation of its earnings after Oracle and other earnings this week. And then, of course, you had the data, which came in earlier. Slightly hotter inflation month over month and more jobless claims than the market was anticipating. You have bonds rallying as well, with the 30-year yield now at 4.65 and the 2-year yield at 3.50. Coming up tomorrow, Andrew Slimman of Morgan Stanley, Joanne Shou of the University of Michigan, plus the CEO of Miami International Holdings. This is Bloomberg.